Thank you for joining us for our third quarter outlook video titled The Standing 8 Count. Headline inflation has been more than cut in half since last June, where it peaked out at more than 9%. Like a boxer who has his opponent on the ropes, the Fed's barrage of rate hikes has inflation teetering. In addition to inflation coming down rapidly, the economy is showing some mixed signals following the aggressive Fed rate hikes. We will take a look at whether we can expect a hard landing with a recession or a soft landing with no recession. Now it's time to take a closer look at inflation. Unfortunately, the inflation that remains is sticky inflation. Goods inflation has come down dramatically, and what is left is services inflation. Shelter costs make up more than a third of the services component of inflation. When rents go up, they have a tendency to go down very slowly. This is in part why the move from 4% inflation, where it is now, to 2% inflation, where the Fed wants it to be, will be harder than the rapid move from 9 to 4% we've experienced. The good news is that shelter costs have a tendency to follow home prices with about a year lag. Home prices have softened or declined in much of the country, and this should help moderate the shelter component of inflation. We believe we will have a soft landing in the economy. The strength of the labor market gives us confidence that any recession will be short and shallow. Presently, there are about 1.7 jobs for each unemployed person, and unemployment is hovering at a 50-year low, around 3.7%. Most people that would be laid off during a recession should be able to find jobs. This tightness in the labor market should keep us from going into a deep, dark 2008-style recession. Long-term unemployment can be problematic. Workers become disconnected from the labor force, and skills can erode, making it difficult for people to become reemployed. One of the high-frequency data points that we watch is weekly jobless claims, or new people becoming unemployed. A weakening labor market would show up here first. Claims have increased recently but remain remarkably low. We would be concerned if the claims were consistently above 300,000 per week, where they've been averaging about 230,000 this year. The recent debt ceiling debate in Congress has highlighted that the U.S. is on an unsustainable fiscal path. Government spending has become a political issue due to higher interest costs, which increases the cost of funding our debt. As illustrated by the graph, the orange line is spending, whereby the blue line is revenues. Other than a few years around the year 2000, the U.S. government always spends more than it takes in. This spread between revenue and expenses is widened due to the pandemic and the elevated level of spending that's projected to continue. There are only two potential solutions to the problem. The first is to increase taxes, and the second is to cut spending. Cutting government spending is exceedingly difficult. Therefore, the political path of least resistance is increasing taxes. Default on our debt is not a risk. The greatest risk is the crowding out of spending on productive initiatives to pay interest. There are some conflicting data points as to whether we will have a recession or not. We have a T-chart with the pro side displaying arguments for a soft landing, in other words, a soft recession or no recession at all. On the con side, we have arguments for a hard landing, which would represent a more severe recession. A very strong labor market is the most prominent feature on the pro list. In addition, corporate earnings, wages, and consumer balance sheets also argue this point. In terms of the hard landing camp, inflation is still too high. As a result, higher interest rates and credit costs are the main reason the bears believe we'll have a deep recession. At this time, we are in a soft landing camp. That said, we do continue to expect a slowing economy, and over the last year, we have positioned client portfolios to navigate this weaker economy. The S&P 500 is up over 15% so far this year, but only 7 companies, which have been referred to as the Magnificent Seven, account for the majority of the return. These companies that most can recognize, including but not limited to Apple, Amazon, Netflix, Microsoft, NVIDIA, and Tesla, very much a list of usual suspects. As of June 20th, these 7 companies contributed 12% of the 15% of the market return, while the other 493 companies in the S&P 500 only contributed 3%. So while the market looks to be strong, underneath the surface, you see more weakness as companies have pressures on their revenues and profits. Which leads me to our next point, is we believe that this bull market could be unsustainable if we don't see broader participation in the rally. Typically in a bull market, we see about 70% of the stocks participate, That's not the case this year. Right now, only 36% are considered in a bull market territory. So we feel we need to see more support before we consider it a sustainable bull market. Now, we're starting to see some signs of support as the ratio of new 52-week highs for stocks minus 52-week lows is started trending higher, but it's still very much of a narrow market. One of the common themes we've seen this year is the story of artificial intelligence. It's no surprise that the 7 companies we saw on the previous page that are driving market returns all have an AI theme to them. These 7 companies already had a strong jump earlier in the year, but then the AI story provided another strong tailwind as some of these companies have revised their financial estimates even higher, and some significantly higher. AI has already been to translate into reality as some business productivity has increased 15 to 20% by using these AI tools, particularly for traditional service markets including data analysis, legal tasks, and video generation. Many investors believe that this technology has the potential to transform almost all aspects of the enterprise and consumer experience. Aside from the AI winners we've seen so far this year, as discussed earlier, there's been some pain under the surface, and this is largely a result of pressure on profits. However, corporate results were actually better last quarter than anticipated. For the full year 2023, corporate profits are expected to be flat when compared to 2022, despite the highest inflation in 40 years that has driven up input costs as well as labor costs. Overall, we've seen margins soften, but they're not plunging. As inflation continues to moderate, we would expect this to be a positive for margins and profits as we move into next year. So what does this mean for client portfolios? Within equity portfolios, we have reduced exposure to cyclical and economically sensitive sectors, such as banks. We've also trimmed down our holdings in commodity and manufacturing companies. In exchange, we've added to sectors such as healthcare, consumer staples, and utilities. Companies in these sectors have a tendency to be less cyclical and more resilient in a downturn. As noted in the title, we are positioned for a slowdown by changing the nature of the equity portfolios, but not a recession, as we have not changed the overall asset allocation mix of portfolios. Managing risk and keeping clients invested is one of the most important things we do. We focus on the long term, which can greatly reduce the market noise. Time is your friend and one of the biggest factors in your investment success. Going all the way back to 1926, we can see that in any given year, if you invested, you would have made money 73% of the time. If you extend that time horizon to 5 years, the chances of making money is 88%. For 10 years, it's 94%, and for 15 years, it's 100% of the time. Not only do you see a greater chance of investment returns, but the volatility of long-term returns are significantly lower. So even as we talk about the current market conditions, it's important to remember that staying patient and invested is your best chance of success. In summary, our takeaways for the third quarter. Inflation has fallen substantially, but now is the hard part. The move from 4% inflation to 2% will be more challenging. The labor market holds the answer. The resilience of the labor market gives us confidence that we're not going to have a severe economic recession. The economy, earnings, and the equity market have been surprisingly strong. Artificial intelligence is everywhere. Artificial intelligence has the potential to provide a massive productivity gain for our economy. The extremely narrow market that we've been experiencing is due for a change. 80% of the market's gains have come from 7 stocks. We do not view this as sustainable. And lastly, what recession? We are in the soft landing camp for the economy. Thank you so much for joining us. We appreciate your trust in Ferguson Wellman and look forward to catching up with you in the fall.